What's going on, guys? Coming at you today with a stock market video, and I want to share with you 5 ways to increase your odds of making money. This is a list I put together and I try to stick to. I've read a lot of books. I've been investing for I started really young. My family was pretty into investing, and that's really what's shaped my perspective on a lot of this stuff. The dot-com bubble is very firmly implanted as an early investing memory of mine. So I've been investing for I guess close to 20 years. I started when I was 12, but it was basically just, me saying I want to buy AOL, that type of stuff. But over time, I've done a lot of reading, and I kind of have more of a philosophy going on some things we can use to stack the odds in our favor. And guys, I don't know what I'm talking about. Don't listen to me. This is not financial advice. I'm just trying to do my best to share some stuff with you. I think these things will be useful, but do your own research. Don't base any of your decisions on what I say. So for a period of time, I had this mindset, I guess you would call it the efficient market hypothesis, which is the market is perfectly efficient. So like Apple stock, for example, it's already perfectly priced. I don't know anything that everyone else doesn't know. So what kind of edge would I have in buying Apple stock? And that's something you got to consider is when you're buying, someone's selling. So there's two sides to every trade. You're basically betting against someone else who probably is smarter than you, especially if you're trading in these really big stocks that everyone is closely following. Apple, Facebook, Google, Microsoft, you don't have inside knowledge or any kind of edge in those stocks. So that used to be my perspective. And for a while, I was just investing in ETFs, low expense ratios, just passively investing. Then I started getting a little bit concerned with the over-indexation, where basically everyone is passively investing. And I kind of view that now as a sort of bubble in its own. Everyone's just passively investing. This can't be good. How does this end? And then I sort of had a renewed interest in the stock market, maybe 5 or 6 years ago. And I did a lot of reading. And I realized you really can still have a big edge if you know where to look. And these 5 things that I'm going to share with you are things you can use to stack the odds in your favor. It's not a guarantee, but it's just if you follow all these things, you have much better odds than picking at random or at just buying what's hot. So here we go. Number 1, the guiding light of investing, in my opinion, is to be a contrarian. Now, everyone says they're a contrarian, but you have to really deep down be a contrarian. So what are some things that right now contrarians would not be investing in? Tesla, Apple, Microsoft, just the common stuff. If you asked a random person off the street, hey, what stock should I buy? The things that they answer, those are the ones you don't want to buy. That's the exact opposite of contrarian. Not to say that they won't go up, who really knows? But all I know is being a contrarian in the long run is what ends up working out. And the reason that it works out is because of mean reversion. It's a really interesting concept, and it basically has to do with, let's take Netflix, for example. Really high-flying company, growing super fast. As things grow really fast and they have big profit margins, that attracts competition. So as you can see right now, NBC has a streaming service. There's Hulu. There's HBO. There's a bunch of other ones, right? There's 10 or 15 of them. There's Disney now, which is a big one. Discovery, Apple TV, Amazon. So many competitors now. Now, one opinion might just be, Netflix, first mover advantage. They're here to stay. They're the best. History would say that's not usually how it works out. So Netflix is going to have reduced profit margins over the next 10 years. I would have to imagine the stock price starts to decline unless they really pivot and get super innovative, which could happen. They've done it in the past. But if you're making a bet, the bet is that the competition sort of starts to equalize, and Netflix does not do as well the next 10 years as they did the prior 10 years. The same goes in reverse as well. So if you're thinking, what's just the worst investment you could possibly make? Coal mining, right? Who wants to invest in coal mining? A complete dying industry. But has it gone too far in that direction to where a lot of coal, I just read actually in the Wall Street Journal, 10 different coal companies are closing up shop. So there's only a few left. They're probably going to be able to increase their profit margins because there's not as much competition. So that's how mean reversion works. There's an industry that's just been beaten down really badly. At the bottom, a lot of companies go bankrupt or they pivot into different industries. And then they mean revert back to more of a normalized profit margin and profitability, and the stock price follows. Same with the high flyers, like the EV stocks right now, cannabis stocks, anything that's just super trendy and hot. there's going to be increased competition, and that will mean revert downwards. If you're looking at the market right now and you're like, man, I really want to get into Tesla and Plug Power and Blink Charging and, all these trendy stocks, you'll have your chance. It's coming. 5 years from now, when the competition heats up and the stock price dips, you're going to have your chance. You just got to be patient. So number 1 is be contrarian. Number 2 is this old saying, measure twice, cut once. So you kind of want to do your research, have a very well thought out opinion, and have some conviction in your stock picks. Make one bet, or maybe you accumulate over time. But in essence, it's just one bet that you stick with and you ride out for a long period of time. The longer, the better. Because there is this thing in investing psychology, it's called a bias towards action. So when you see the stock price go down a lot, you're inclined to sell, maybe you're inclined to buy more. Whatever your natural inclination is, a lot of the times, just holding steady is the right thing to do. We have a bias towards action. Because a lot of the time also you're like researching, you're putting a lot of hours into understanding a business, where you think it's going to go. You do all this research, and then at the end of the day, do you really just want to be like, no, I'm going to pass for now? Your bias is always towards making the buy or making a sell when things are trending downwards. It's easier said than done, but there are some things you can do to make it easier. Basically, just having strong conviction before buying is number 1. And I heard someone say once, the only time you sell is when your reason for buying is no longer there. So if you're buying a stock because you think there's going to be some breakthrough new drug that the company has, then the breakthrough drug comes through, the stock goes up 300%, and you're like, but I think they got another one in the pipeline. That would probably be a bad decision because your original reason for buying is gone. It's already been realized, so that would make sense for selling. You want to think things through, make measured decisions, because now more than ever, like with Robinhood and just the way the market's moving, you feel like you have to do things quickly. And I think when you get that feeling, that's the exact opposite of what you should be doing. You should actually be really taking your time. Rule number 3 is don't lose money. Obviously easier said than done. This is Warren Buffett's rule number 1, and rule number 2 is refer to rule number 1. So how I think of this is just like downside protection, right? So when I look at specific stocks, here's a stock I like that I actually own, Altria. So tobacco company, really out of favor basically because everyone is very environmentally inclined. There's a lot of incentives to not own companies like Altria, tobacco companies, oil and gas companies. To me, that's a reason to own them because there's certain people that just can't own them. So when I look at this company, it's trading at less than 10 times earnings. That's really tremendous downside protection. You look at the financials, holding steady, even most people would be surprised to see this, actually increasing revenues over time, and that is just because they have extreme pricing power. There is an extreme competitive advantage because there's no new entrants in tobacco because of regulations. So as far as moats go, they have a really good one. They pay out 8% dividend. It's just really safe. The downside is not that low. Like, could it go to 30? Even you can see here in March 24th, March 23rd, it went down to 31.30. Really, your downside is maybe like 25% or something at this price. So that's just sort of an example. I think a lot of people, when they're looking for a stock to buy, they're thinking of the utopian future of like, oh man, everyone's going to be driving electric vehicles. Tesla might even be like building batteries for, intergalactic space travel. They're thinking like 200 years in the future, how much money is this business going to be making? Number 1, predicting the future is really hard. Why not just take the sure thing? So the perception is that you're investing in this really innovative business like Tesla or a lot of these EV stocks. The reality is the downside is quite high. So for example, this is one I've been looking at a lot. So there's this company called Celsius Holdings. Now what they do is they make energy drinks, right? Not anything super crazy. And I've actually been looking because I've like this stock is just mind boggling to me. I've been looking at the grocery store to see how prominently displayed they are. Like what's their real competitive advantage? But guys, this stock is trading at 520 price to earnings. And if you guys are unfamiliar with price to earnings, basically think of owning a stock as a business owner. So say you're going to buy the local restaurant up the road, just on the corner, and they are doing $1 million in revenue, and on the $1 million, they make $200,000 in profit per year. what would you pay for that business? Say you could maybe get in there, you could optimize some things. Maybe you end up making 300,000 per year as opposed to the 200,000. So right now, what would you pay for that business? The right answer is probably something like 600K to $1 million, like 3 to 5 times earnings. Seems reasonable to me. That's probably what I would pay. And then you look at something like this and it's 523 times earnings. And if we look here, you know, their revenue is growing kind of fast. Not even that fast though is the thing. It's growing like, I guess that's what, 50%? Yeah, I mean, that's pretty fast. It's growing about 50% per year. They just turned a profit. They made $6 million over the last 12 months. So guys, for $120 million of revenue, you're paying $4.6 billion. Just completely absurd. So the reason you're paying that much is because the market is saying this company is going to continue to grow at this price for the next 20 years. So that's a really long-term bet you're making. To me, it's really hard to predict that. You know, the tastes of people change. There could be new entrants. It's very far from a sure thing. But the honest fact of why people are buying the stock is most likely because they think they can sell it at a higher price. It has nothing really to do with the underlying business. So to me, this is an example of, if you're following the third rule in this video, which is don't lose money, this is a really bad way to do that. Because right now it's trading at 523 times earnings. Who's to say that next year it won't trade at 15 times earnings? You know, like just multiple compression. Because here's an example of this sort of phenomenon at play. So Cisco, for example, it peaked way back here in 2000. And Cisco as a business did pretty well over the next 20 years. But the stock, because you paid so much for it, you paid such a high multiple, the stock ended up not performing. Same with Microsoft. All these companies, like you bought it down here. Obviously, it's done amazingly well lately. But if we zoom in down over here, you bought it at its peak. It took almost 15 years to exceed its 2000 peak just because you paid such an expensive price for the business. So that's an example of not observing the rule of not losing money, because this is just setting you up to lose money. The downside's so high. What if the market just doesn't value the stock at this multiple anymore? Whereas when you look at something like Altria, like I just showed, the market's valuing it at 10 times earnings. Is it really going to value it at like 2 times earnings? No, because you know everyone would buy it. So that's downside protection. I think that's more important than upside. A lot of people these days in this market, and pretty much always, it's a human condition, are looking to get rich quick, so they want the upside. Rule number 4 is going to be know where to fish, and this is a concept by Joel Greenblatt. I've read a few of his books. How to Be a Stock Market Wizard is really good. And essentially what he says is you want to be looking in areas of the market that are just set up in your favor. A big one he talks about is spin-offs and small and micro cap stocks, just undercovered stocks. So for example, when you're looking at a stock like Apple, there's maybe 30 different analysts covering it. Everyone has an opinion on Apple who's an investor. So the price of Apple stock is going to be pretty much priced to perfection. Your input into the price is not going to have an advantage over, you know, like someone working at Merrill Lynch or Goldman Sachs, right? You don't know more about Apple stock than they do. So does it make sense to be betting against them when you're buying Apple stock? To me, it doesn't really make sense. So I pretty much stay away from large cap stocks in general, except for special circumstances like tobacco stocks, because you have to be a big cap stock to even be in the tobacco business. And there's reasons why I think the stock could outperform, because a lot of people just can't buy it because of the environmental aspect of it. And what I think is the best place to look is just in small and micro cap stocks, generally under $1 billion in market cap, because a lot of these stocks will have no analyst coverage. They will not be included in any indexes, so there won't be any passive flows coming into the stock, which is not really good for the success of the stock, but it could be really good if the stock ends or the company ends up doing well and the stock gets added into an index. So if we look at just a really small stock off the top of my head, there's this one, it's called Ballantine Strong. They are about, I think, they're $35 million market cap. So pretty small stock. And we can look here. This is on Guru Focus, which is a website I use occasionally. You can look and see who the top fund holders are. And in here, There's almost no big passive funds. So there's Vanguard. That's a big one, of course. But they only own 2% of shares. BlackRock is another big one. So they own a really small percentage of shares. So, there's a little bit of activity here where there's just passive investments being made. So what that means is people in these funds that are buying these funds, they're not saying, I want to own Ballantine Strong stock. They're just saying, like, I'm going to invest in the Vanguard Total Market Fund or whatever, and it automatically buys all the stocks for me. When you look at something like Apple, you see pretty much the entire page here is just, passive investments. Vanguard, BlackRock, Warren Buffett. I think Berkshire Hathaway owns a big percentage of Apple. State Street, just all these just passive investments. So that's the difference. And if you think like me, how I mentioned earlier, I think this passive investing is kind of bubbly, where everyone just every month is just contributing to passive investments. I think there could be some sort of exodus from that at some point, and I want to be positioned to take advantage of that. But even if that doesn't happen, I think you're just better off. You have more of an edge. The competition is so much lower when you're looking at these smaller stocks. And the biggest tip of all, the number one thing you can use to your advantage to make money in the stock market is time arbitrage. That's the number one way a small person like me, just like an individual investor, can do better than the big hedge funds and all these type of people that have all this brain power and manpower behind their picks. Basically, you just buy and hold. You have a really long time horizon. You can underperform for quarters or years, which the hedge funds can't do. They have to perform every year or they risk people taking their money out. They're all about trying to accumulate assets under management, so they need the quarterly performance. They got to put up good numbers. You can take a hit for a year or two if it pays out in the long run. So that's why a few things that you got to be comfortable with, in my opinion, to really make good money is volatility. So say you take a 20% drawdown, but then you get like a 200% uptick. That is something hedge funds can't really do. They can't take the drawdowns like that. You can take a little bit more pain and have more of a long-term time horizon. And there's this cool concept. It's called the coffee can portfolio. And it was in this book called 100 Baggers that I read recently. Essentially, there's a person, I forget the exact story, but a guy would buy, he would actively manage his investments. And whatever stock he would buy, he would just buy an amount and put it in his wife's name. And that would be the coffee can portfolio. And he kind of just forgot about it. He would buy it, leave it there, but he would be actively managing his fund. And over time, he picked a lot of good stocks, made a lot of money. And then I think 30 years later or something, or maybe even longer, 50 years, when he died, or it might have even been when he died, someone looked at his wife's holdings and compared them to his performance. And he was doing really well, but his wife completely eclipsed him by just not touching anything. Everything you buy, you never sell. This is the coffee can approach. It's not what I do, but it makes a lot of sense. And basically how it ended up working out is a lot of the stocks, maybe like 80% of them ended up going to zero. And the few, maybe the 20% that she still had, they split into a bunch of different companies and ended up eclipsing the entire value of her husband's portfolio. So that's just sort of shows you the power of time. You let these things compound over time. You get into a good business. You let the business do all the heavy lifting. They just keep on compounding your capital over time. And 30 years later, you're a millionaire. That's sort of how it works when you find the really good businesses. A lot of these things are counterintuitive and they go against the way we naturally think. We get in there and we're like, oh, what's the stock that's going to grow the most? What's the best business? As opposed to what's a really good business that's reasonably priced. A lot of times people just go into the stock market and they're like, I want to buy the best businesses. The best businesses are also the ones trading at an extreme premium a lot of the time. You don't want to go out there looking for the best business. You want to be looking for the best deal. So that's going to do it, guys. That's the list. Hopefully this helps you. That's kind of how I'm thinking. My thinking's always evolving though. So for right now, this is a lot of the stuff I'm putting to practice. Hopefully this gives you a little bit of a different perspective and it helps you. Thanks for watching.